Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Thursday, January 22nd, and I'm delighted to be joined here by Matt Rice, who is CEO of Vistamark. Welcome, Matt. Thanks for joining us here.
Thanks, Ethan. It's great to be here.
Well, we are coming off the back of a dramatic week in terms of geopolitical developments, and we've called this podcast Drama at Davos. So let me bring up the slides and we'll kick this off. Obviously, we've had a dramatic week in terms of geopolitical developments. And as usual, we will cycle through inflation, interest rates, equity markets, geopolitics, and other asset classes, with a particular focus on the geopolitics this week and how that has affected different asset classes. In terms of some of the sub-themes, not only have we been looking at drama at Davos, there has been a little bit of drama in the Eastern markets as well, with Japan experiencing a blowout in its bond yields in what some have said is akin to Japan's Liz Truss moment. That, of course, being a reference to the time at the end of 2022 in the UK when there was a flight of institutional investors out of UK gilts, and that then heralded the short end to Liz Truss's prime ministership. And we're going to look at this ongoing defining year for metals and how metals have been behaving, given the behavior in other asset classes. We'll talk about the price of oil and how that has, whether that has been affected by geopolitical developments. And as always, reflect on equity markets and how this has had different implications for portfolios. This is our special guest, Matthew Rice. He's the founder and chief investment officer of Vistamark Investments. Matt and I got to know each other when he was CIO at Fiducient, which is a fund that a firm that Moneta has used as consulting. So once again, Matt, welcome and great to see you here.
Thanks, Ethan. It's great to be here.
Well, and we're going to start with our typical part. We start with the vibes in the economy. And we'll speak with it to start by talking about inflation. Inflation hasn't had as much attention in the headlines, just as geopolitics have dominated, but we have seen affordability come to the fore. And last week in the podcast, we spoke about inflation coming nearly back to target despite rising food prices. And it does seem that the trajectory is downwards. And this, of course, will have an effect on how the Fed reacts and how they react around interest rates. And I'd like to ask you, given your work at Vistamark and your work with institutional investors, how are you thinking about the trajectory of inflation today and building resilience into portfolios around that?
No, it's very timely, Ethan. We're just finishing up our 10-year capital market assumptions projections for the next decade, where inflation is obviously a big piece of that. And, we've been doing that for 25 plus years, and there's really been 2 years within the history. 2009 and 2021 were 2 years that we sort of deviated from our normal methodology, or really just looking at the break-even inflation rate between the nominal and the tip. Kind of that difference really being the implied break-even inflation rate expected by market participants. I think we're finally back in 2001. The market wasn't pricing in much inflation. They'd missed kind of the entire COVID, all the seeds that were planted in 2020 for inflation, and we sort of expected that to come. And of course, we were right in terms of boosting that. And we had a similar dynamic in 2009 when kind of a flight to quality liquidity kind of boosted the nominal relative to the tip sort of artificially. We thought that it baked into the markets was zero inflation for the next 10 years. If you looked at the tips break-even spread in 2009, that was obviously didn't make any sense to us. But I think we're finally in an environment now going forward where we're back to a more normalized inflation number, right around 2.2, that break-even inflation rate. So I think we're coming back into a normalized inflationary type of market. And I think a big part of that is, in addition to kind of the more normalization of global trade and things like that, to the extent, or new normal anyway, we have, I think, probably one of the biggest disinflationary forces ever to hit the markets, and that's really the AI. Similar to what China was many, many years ago. China was the biggest exporter of deflation really across the world like 20 plus years ago, and I think AI is going to have a similar dynamic to that.
That's a really interesting thread, and I think let's just jump into that now, because that what's your time frame on that as a deflationary force? Because I think we've had the Cathy Wood narrative around tech, the gig economy, the ever cheaper components, etc. which has been a deflationary pulse. We then disturbed that with COVID and some of the supply chain issues. But right now, it seems that AI spending is dominating. When we have had charts in previous podcasts looking at CapEx spending of the large tech companies alone, and that has skyrocketed. So clearly spending on AI is taking up a lot. And when do you think we'll start to see the benefits of this disinflationary force?
Well, I think we're seeing it in the areas of the economy that aren't tech. And I think everyone's focused, rightfully so, on the profits that are going to be made directly by AI companies, hardware providers of, chips and software developers that are kind of creating the technology, this magical. I think my grandfather, World War II era, would think this is just magic. That's kind of how incredible this is. But what I think what's being missed really is insurance companies, healthcare companies, all these other companies deploying this technology, like our business, my business, businesses, just normal businesses deploying it, where I think 90+% of the economic benefits and the disinflationary aspects are going to circle through to mainline companies that basically are able to either increase their profit margins or reduce the price of their services over time. And I really think that's the piece that's really disinflationary. Of course, there might be an inflationary piece because of the demand of chips and things like that kind of happening. But I think the much bigger impact is really going to be that technology being deployed. Think about the world before we had the personal computer and before we had Microsoft and we had Windows and everything was. I remember when I had to drive back into the office at night if I wanted to check my emails. That's how old I am, and just kind of how this new phase of technology is really just taking it to the next level in a very, very extreme way.
So something to keep in the back of our minds. This force, then, of course, as we see some of the pricing, say, on food, which maybe affects people a little more viscerally. Moving now to the vibe check, and it's impossible to really talk about the vibe in the economy without bringing geopolitics in at this point, as it has certainly in the last week dominated the headlines. We know that there was not only a threat around Greenland and buying it, or even at one point discussion of force that seems to now be off the table. But the interesting part was the kind of weaving in the tariff threat again, which did appear, and we know that markets did not react well to tariffs appearing on the agenda again, even though they now seem to be off the agenda. So I suppose just in terms of this markets, how when you think about tariffs and the effect on markets and how they react, how do you think about markets' resilience when it comes to some of these economic headlines?
Well, I think that the market is proven over the last couple of decades, in my entire career, the economy and markets have proven to be far more resilient than I thought they were in the moment. I think that's kind of true of all of us. Oh, this is the end of the world, and then you get a few months past it, and the market kind of changes and evolves. From even COVID, I'm like, wow, this economy. If everybody's locked down, like nothing can happen in the economy. Well, that's not true. Capitalism sort of finds a way. And so I think the market just is a lot more resilient and the economy is a lot more resilient than people think.
It certainly has been a dramatic week, I'd say, in that respect, in terms of headlines. And I'd say, given the media handling, there has been a sense, and looking at these charts here, it was a bad day for global indices. It's not just a US centric problem. I think the important thing is they're now comparing it to Liberation Day. In terms of that is the benchmark. If nothing is as bad as Liberation Day, the markets stay resilient. Some of the other points here just to bring in. So the obviously inflation, affordability, that all affects the interest rate trajectory. We've had quite a lot of noise around interest rates recently, not just around Fed and their likely trajectory. We've had discussion around mortgage rates being affected as well and being almost driven down, as well as credit card interest rates and how those will be capped out potentially. And obviously, interest rates do affect the consumer greatly. This is a bit of an affordability drive. What's your current, given we've discussed inflation, we've discussed deflationary forces, what's your current take on the interest rate trajectory, given where we are with the Fed, and how do you see the year playing out?
Yeah, I think right now, I think the interest rate trend is going to continue to be slightly down here, even though I don't know that it should be. I think if we go back and look at During everyone, of course, remembers Greenspan and Volcker, but I think a lot of people might forget Art Burns, who was the Fed chair during Nixon's administration. It was the minute that there was inflation that got running heavy during the Nixon administration, and then it started to cool off a little bit. Then Burns started to cut rates quickly. And then sure enough, it came back and started hitting the economy really hard again. And then Volcker had to come in and clean up that mess later on. I think a lot of people forget that. So yes, we've seen inflation come down, but when you kind of look at the economy, there's not like an immediate need, I think, to be cutting rates. And there hasn't been for the last couple of rate cut cycles. So I think to a certain extent, the jawboning of Trump has worked. I think people are like they're saying the Fed has maintains its independence and all of that, but they're certainly erring on the side of cutting right now, and it's not exactly clear to me why it is. Yeah, there's maybe a little bit of softening going on in the labor markets and such, but I don't think inflation has been on a downward trajectory long enough to begin to kind of cut the way we have, and I think it's going to continue to cut here, and I'm a little concerned about that might end up spurring a second wave of inflation during the second half of 2026, but. We shall see. And I think whoever comes in as the next Fed chair, and when that happens, obviously there's going to be potentially there's going to be a little self-selection bias there that whoever comes in is going to be somebody that Trump approves of. And there might be, a mutual understanding that interest rates are headed lower no matter what, to a certain extent, unless there's something egregious from an inflation perspective popping up.
And I would say, I think we would hold that same view that with the current resilience in the economy, as well as the existing inflation being in check, there wouldn't seem to be it would suggest that we could not necessarily need an inflation, not necessarily need an interest rate cut, but certainly I suppose one could be tolerated and at the current levels of inflation. Last week we were speaking a lot about the economy being maybe red hot, and the president and other policymakers being prepared to run it red hot for a period. Certainly, our view is that the current state of interest rates, there's potential to have kind of a back pocket cut as a potential stimulus sweetener to the economy, should there be some issues down the road. And that is a little bit of a sweetener, I would say, or a bit of a backstop in terms of where we are. The other chart on this page is around metals. And I know that we've spoken a lot about this being 2025 as the defining year for metal. 2026 has seen some pretty interesting metals action. And equally, we've seen the metals rallying again during the geopolitical turbulence of the last week. So definitely fulfilling their role as a kind of hedge and a flight to safety. How do you think about using metals in your client's portfolio? Do you use them as a hedge? Do you use them at all? How do you think what role do they play?
Yeah, it's a good question. First and foremost, you could look at this and say, is this really the price of metal going up, or is this the price of the dollar going down, or some combination of two of those? But like gold has been a beautiful shiny metal for thousands of years that humanity has thought has intrinsic value associated with it, and it's when governments and start to debase their currencies and start doing things that kind of give people less confidence that their fiat currencies are going to be sort of backed in a real sense, and that there's actually enough backing there, that it tends to do well. I think, gold is kind of and other precious metals is kind of a diversified real asset, can make sense for those tail assumptions, and throughout human history, I think there's not been a civilization that's eventually not debased its currency into nothing and kind of had to start over at some point. So I do think that there can be room within a real asset portfolio for inflation, real assets, things like precious metals, things like that. This is sort of like crypto is beginning to eat a little bit of the gold lunch in terms of being an asset that it's kind of in a place that you can go to kind of protect against debasement of the dollar, although it certainly has not been around for thousands of years, and certainly does not have kind of that long-standing history of predictability in terms of how it performs in various environments throughout hundreds of years of history.
Well, we will come back to that debasement of the dollar point when we get back to how some of the assets have moved in sync in terms of the equities, the bonds, and the debasement of the dollar. I just suppose of other kind of trends that are happening at the back here. As I said, we have had a lot to contend with in the year to date so far, the mere 3 weeks of the year. Discussion around this big Mac trade, which has been, I think, the coin term given to the midterms are coming, and that is traditionally a difficult year for markets. So that I suppose is pressing perhaps at the back of the mind that the traditional intra-year drawdown during midterm elections can be 18%. So not necessarily that same kind of tailwind that we would see in presidential election years. And as I mentioned, equity markets, whether it's a sigh of relief or just a sort of sign of anxiety, they have had this was the 21st of January. So as of yesterday, 3 sessions showing some negativity, but definitely rallying as markets watched President Trump's speech at Davos, kind of breath by breath. This is the slide around American exceptionalism. And one of the points that I think this is interesting, and I'd love to ask you about how you think about the global allocation for your clients, is that the indicator of how currency, equity, and bonds falling simultaneously has been declining in the US, whereas in other countries that has been, I'd say, on trend. And some of the other countries, France, Italy, the UK, Japan, have perhaps each got their own issues. Do you find that how do you think about US exceptionalism and with your clients, and do you stress the global allocation? Have you been changing that view as the US has seemed to be more and more resilient?
Yeah, I mean, we haven't made any fundamental shifts. I mean, for 20 plus years now, I've been an advocate of really that global diversification idea. And we've always maintained a bit of a modest home field bias within the United States, in part because United States investors, we spend in US dollars. And so there's a little bit of an advantage to wherever your home base is on a risk adjusted basis to kind of have your perhaps a higher allocation to your own home currency, since you don't spend money in yen, you don't spend money in euros, you spend money in dollars. That should be, the predominant currency basket of assets. Your assets should be predominantly denominated there. But we're, within our client portfolios, we've been very global in terms of how we're positioned. We've been allocating to global mandates that we think are, within both dedicated international, dedicated US, as well as global. And the global mandates, we allow really our managers to go out everywhere within the world and really find the best companies no matter where they reside. And so I still think, I think there was this thought many, many years ago that as globalization continued, that we really didn't need to have domestic versus international. Everything should be global and only global, and we should just go wherever the best companies are. I think with kind of a move away from globalism a little bit, that there is becoming more argument to kind of reestablish beachheads of X% US, X% international, and kind of control that at the client level and not necessarily allow, a manager control that completely independently.
That's a really interesting point. And I think that is the decline of globalism, because one of the points, and this brings me to discuss Japan here, despite the fact that US exceptionalism seems to be the new mantra, at least around markets, and the US standing alone with some of its resilience, some of its tech trends, perhaps, and some of its just as the bond market being very low volatility, very relaxed, very chilled out, it seems, given some of these other developments on the geopolitical stage. The interesting point was that there's still the potential for contagion, as even we've spoken and shown charts of the market hiccup this week. And even high-level officials such as Scott Bessent was suggesting that that was directly attributable to the movement in the Japanese stock market, in the bond market, that it was not attributable to concerns around Greenland or geopolitics. And what we have seen this week is a historic sell-off. The 30-year JGB government bond has never before suffered such a big fall in one day. We see the long-dated yields surge in Japan. I have shown here a chart, which is the actually equity market in Japan, which up to now was up 40% in the past year. So quite a lot of counter movements there. And just some more charts in Japan surpassing 4% for the first time. It's a bit of an unusual turn of events there, suggesting perhaps a crisis of confidence, whether it be in the new prime minister and her snap election, or whether it's just a kind of a shock development, perhaps that will resolve itself. But I did find this interesting that something in Japan, in the bond market in Japan, could be a reason for shocking markets in the US. Do you think that perhaps the bond market is still something that gets watched to that degree, that when there's even a shock event in Japan, that could send chills into the US investor?
I think it could. And I think Japan has been a debt to GDP basket case for a long, long time. And as we've done our 10-year capital market assumptions, we build our projections. Japan's bond market is a big piece of the globe in terms of the overall global bond market. And we've always been blown away by how low Japan's yields are mixed with what a basket case they are. They look more like, they've been teetering on, if you just look at debt GDP, a country that's on the verge of a crisis for many, many years. And so the market's seeming to now recognize today, as opposed to 3 years ago, 5 years ago, the basket case that is Japan from a debt to GDP growth is interesting. So the market's finally waking up. And I guess it means that, I think I would point to Japan and say, you always have more time than you think on a financial crisis to hit, because things can make no sense for a long, long time until one day the market wakes up and realizes what's going on, and that there's a very low probability that you're going to get repaid, unless, without significant currency debasement kind of happening. And that's sort of what happened with Japan. We actually used to give a big haircut to the Japanese bond market with the assumption of this day eventually being inevitable. And I think that the concern here is now that with Japan being maybe the canary in the coal mine, other people are going to look at other unsustainable kind of debt loads throughout the globe, including the United States. I mean, we got a long way to go before we're anywhere near as bad as Japan, but we are much bigger and much more important economy globally. That I think you could take a look at what's going on in Japan today and see it as a potential future if we don't get our fiscal house in order in the United States and get our debt and deficits back onto kind of more sustainable trajectories.
That's an excellent point. And I think we've been speaking this verb, the Japanification, has been kind of popping up in our discussions for years now. I think for a while it was to do with the idea of a deflationary environment. This is pre-COVID. We know that Japan suffered from very low inflation, if not deflation, for years. And that seemed to be coming. That was a specter pre-COVID anyway, before we dealt with spikes in inflation. There's also, I suppose, the point about the aging population. I think we've seen statistics this week about a dramatic fall off in birth rates, particularly in China, where there are fewer babies being born in China in this year than I think 2 centuries ago at one point, and they would be on a trajectory for a halving of their population if this trajectory were to continue. That seems to be a global phenomenon. So I think it is that kind of a salutary reminder not to be too inward looking when it comes to that spark for the next crisis. And I think a good reminder that despite US exceptionalism and very US centric portfolios, perhaps for some investors, we do need to look elsewhere. And I'd say, just pulling on that thread further, oil prices. One of the things that also seems to be heading down in line with other inflation is the oil price. And interestingly, even though we have had news around Iran this week, it hasn't been necessarily interrupting the long-term trend downwards in oil. And equally, looking at the oil inventories here on the bottom right chart, the inventories are remaining quite high. So that would also suggest that the price is going to see some downward pressure there on oil. One question I often get asked is around the electricity trade or the energy trade, whether I would be bullish on that. We know that energy and AI are often thought about side by side. Do you have a thought on energy pricing, given that oil is heading downwards in this way? Do you think the energy sector will still be a beneficiary?
Well, I do. I mean, I think energy is so important right now. It's always been important to our economy, but I think with the AI and the amount of energy required kind of to generate that, and that's really becoming, I think, just an expanded part of demand within it. And then we talk about really oil too. I mean, I drive electric cars. I think we're ways away from that kind of being able to be scalable across the world, but there's going to be, electricity demand kind of rising as you continue to see the trend to move towards, converting our automobiles to electricity, as you know, and kind of away from oil and gasoline consumption. So I think I think it's just looking at the ability to create energy, the supply kind of capacity, and then the likely demand for energy over the next 3 to 5 years. It's hard not to see demand winning out a little bit over supply in the next 3 to 5 years. And it's not that complicated. When demand kind of outstrips supply a bit, you start to see a rising price. And so I would be really bullish on non-oil energy prices over the next 3 to 5 years in terms of rising prices, as opposed to flattening to falling prices there.
Absolutely. And clearly the demand is not letting up there. And this really just brings, I think that's what is interesting in the current set of trends and counter trends. We've spoken about energy definitely having strong demand, yet oil being lower. Oil takes some of the pressure off the consumer briefly, especially the ones that still drive regular gasoline vehicles and that may use oil in other ways. It takes some of the pressure off companies in the corporate world. Equally, then on the metal side, we've seen metals act as a hedge and then continue to rise in this geopolitical situation. And then finally, speaking of energy, I think it's a good time to find and end the podcast discussing Europe briefly, as this is going to be another sort of global allocation for most investors. We know Europe is at the forefront of renewable energy and wind, solar, and certainly other battery storage. It did seem to come into the crosshairs of Davos again, more of that drama point we brought up, and was more of a wedge issue. But I would think that because there's very little political pushback around renewable energy in Europe, it's probably where we will see a lot of innovation. We are, I think, getting a lot of focus. Obviously, Davos is in Europe, so we're seeing a little focus on some of the European dynamics right now. We know that there is a lot of rhetoric around Europe. The power dynamic is driving European defense stocks higher, and they went even higher this week. So that's, again, another sign of how a global portfolio can be a hedge. And I think there have been some interesting comments just in terms of the AI wave in Europe. And we know that AI is a global phenomenon, as you mentioned, a deflationary force. I think what we also know is that there are shortcomings in terms of some of the European infrastructure that can perhaps service these data centers, as well as the financial speed and the regulatory hurdles around financing some of this AI build out. So I think a lot of focus on Europe and its somewhat sclerotic nature at times when it comes to regulation. But if we look at just the defense stocks alone, as well as renewable energy, we know that Europe is still a force in its own right. And I think just to kind of as a concluding thought there, you mentioned having not changed your global view. How do you think about Europe as an investment center, an area to have exposure, and as a long-term place to diversify a portfolio?
Yeah, I mean, I think a lot of Europe is an extremely large segment of the economy. It's it's been around for hundreds of thousands of years, longer than the United States and civilization, and I think there's a lot of great companies in Europe that are going to do very, very well in the coming decade, and it's going to be an important place to invest. I think from a growth perspective, it might not be like it might not be like the fastest growing place, but for multinational companies selling into the globe, it doesn't really matter what your domestic growth trajectories look like. It matters more what the globe looks like, and the consumers or the companies that buy your products, and those companies are located all over the world. So I think, whether it's technology on energy, whether it's aerospace and defense, other companies, I'm thinking of Airbus, companies like that, their products are going to be in demand. And I think it's a place that needs to be invested in, and it might not be, from a United States investor, a global market cap weight, but it shouldn't be significantly below global market cap weights. And if you're European, it should be an overweight. So.
And absolutely, and getting back to that point about dollar debasement, certainly the currency, the euro, not a reserve currency to the same degree as the US dollar, but a decent hedge certainly against it, and to have in a diversified portfolio. Well, that brings us to an end. I think it's been a week where it's been difficult really to know where to focus, given the jostling headlines, the drama, the speeches. We had a focus on Mark Carney's speech, on President Trump's speech, both signaling different views of the world and of the New World Order. And I think there has been a lot to digest. There are two slides I didn't even get into the deck, and I think it took my attention this week. And one was around spirit inventory building, and that was another interesting point around just like the oil inventories are building. It seems like with dry January or other more sort of discernible trends in consumer preferences, that some of the alcohol companies are struggling, and that might be a new trend we also look at from a standpoint. And the other chart, which I'll put in the Substack, is around the data center cancellations. And I thought that was another interesting point. We have seen perhaps a ferocious build out of data centers, and just probably a little pullback on that in terms of the enthusiasm, and perhaps just a need to slow things down a little bit. So a lot of cross currents. Matt, thank you so much for coming here and helping us navigate this turbulent week.
Thanks, Ethan. It's great to be here.
Thank you very much. And thank you, everyone, for listening to this week's Markets Happy Hour podcast.